Welcome to Iron Financial. This is the channel where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we're taking a hard look at McCormick Company, ticker MKC. Now, their Q1 earnings report just hit the street, and let me tell you, on the surface, it looks like an absolute monster quarter. But you know how we do things here. We don't just read the headlines. No, we grab the heavy tools, we crack these numbers wide open, and we see if the foundation is as solid as that shiny facade. And wow, what a facade it is. The headline number that had everybody buzzing was this one, a massive 16.7% increase in net sales. You have to understand, in this kind of economy, for a company that sells spices, that kind of growth is almost unheard of. It screams powerhouse. It suggests a company that's firing on all cylinders, a true fortress of flavor, just dominating its market. But is it real? Let's find out. All right, let's lay out our plan of attack. We are going to run a full diagnostic on this thing. First up, we'll look at that headline win. You know, the pretty numbers they want you to focus on. Then, section 2, we start cracking open those sales figures to find out where that growth is really coming from. After that, we deconstruct the profit story. And trust me, there is some serious accounting magic going on there that you need to see. From there, we'll check the foundation, their history of dividends, which is a key pillar of their stability. Then we get to the main event, the Unilever bombshell. This changes the entire game. And finally, we'll deliver our final verdict. Let's get to work. Okay, let's start at the beginning. Section 1, the headline win. This is the story you get straight from the company's own press release. It's polished, it's positive, and it is absolutely designed to make investors feel great. On first impression, it looks completely flawless. And here it is, the narrative straight from the top. The CEO, Brendan Foley, is painting a picture of strength, of resilience. He's pointing to strong growth across the board, sales, income, earnings, you name it. This is the official story they're broadcasting to the market. It's a message of pure confidence and solid execution. So let's put some hard numbers to that story. Net sales, they came in at $1.87 billion. That's up nearly 17% from last year. Adjusted earnings per share, or EPS, hit 66 cents, and not just crushed what the analysts on Wall Street were expecting, beat them by over 11%. Even their gross profit margin edged up a little, which, believe me, is really tough to do in this inflationary environment. And to put a cherry on top, they reaffirmed their outlook for the entire year. By any normal standard, this is what you call a beat and raise quarter. It looks like a total home run. But this is Iron Financial. We don't stop at the surface, right? That 17% sales growth looks incredible, but a building's strength isn't about the fresh coat of paint. It's about the internal structure. So, in this section, we're going to find out if that growth engine is for real or if it's just running on borrowed fuel. And that is the absolute critical question, isn't it? That number, 16.7%. It looks solid. No one's denying that. But was that growth earned? Was it from selling more spices to more people, out executing the competition? Or was it just bought? Let's break it down and see who's actually doing the heavy lifting here. Okay, now this table here, this comes directly from McCormick's financial filings, and it tells the real story. Look at that top line. Total net sales growth, there's our 16.7%. Now slide your eyes over to the right. See that column labeled organic? That's the real measure of the core business performance. How are their existing products selling? The answer? Up only 1.2%. Now look at the next column, acquisition. Boom, 12.4%. That is the growth that came from buying McCormick de Mexico in January. The core business is barely moving. And this bar chart just makes it painfully obvious. That massive blue bar, the 12.4% from the acquisition, it is doing all of the work. It absolutely dwarfs that tiny little sliver of organic growth at the end, which is just 1.2%. The rest of it, that 3.1% in the middle, that's just a little gift from favorable currency exchange rates. So, you see, this isn't a story of a powerful growth engine. It's the story of a company buying another company to make its top-line numbers look fantastic. So, here's the bottom line. This is the crucial takeaway. When you strip away all the financial maneuvering, when you get rid of that acquisition, the underlying business is essentially stagnant. Now, that's not a sign of a company that's dying, but it is absolutely not the picture of a high-growth powerhouse that headline number wanted you to believe. This is growth by acquisition, plain and simple, not organic expansion. And for an investor, that is a critical distinction. It's a potential red flag. All right, now let's see how this facade holds up as we move from sales down to the bottom line, to profits. Because if you thought the sales story had a hidden layer, oh, just you wait until we deconstruct the profit story. This is where we go from a little bit of financial engineering to some full-blown accounting magic that literally creates what I call phantom gains out of thin air. So get this, the company reported a stunning earnings per share of $3.77. Now, to put that in perspective, that is a 528% increase from the 60 cents they reported in the same quarter last year. Let me say that again, a 500% plus increase. I mean, that's not just a home run, that's a grand slam into the next county. But it sounds impossible, doesn't it? Is this real, or is this all hype?
It's not real, not even close. Here's the number that actually matters, the number that real investors who care about the actual operations of a business look at. The adjusted earnings per share was 66 cents. Just look at that contrast on the screen, $3.77 versus 66 cents. The difference is just enormous. So where in the world did that extra $3.11 just appear from?
It came from this little piece of accounting jargon, a non-cash gain on remeasurement. Okay, let me break this down in simple terms. McCormick already owned half of the McCormick de Mexico business. When they bought the other half to get full control, accounting rules forced them to revalue their original stake up to the new higher price they just paid. This created a massive one-time paper profit of $3.22 per share. It's not cash. It didn't come from selling more spices. It is a pure accounting entry that wildly inflates the reported profit number.
So let's just put a nail in this right now. The real, operational, from the business profit growth was a very respectable 10%. They went from 60 cents last year to 66 cents this year. You know what? That's a solid performance. I'll give them that. But it is not a 528% explosion. The headline number is a complete facade. Understanding the difference between that accounting gain and the actual operational gain is absolutely key to seeing the true health of this company. It's solid, but it's no rocket ship.
All right, so we found some pretty serious cracks in the short-term growth story, haven't we? The sales numbers are bought, not earned. The profit numbers are inflated by accounting tricks. But what about the long-term structure? Is the company itself built on a solid foundation? To figure that out, we have to look at one of its biggest, undeniable strengths, its dividend history. This really is the central pillar of its long-term stability.
Now this is truly impressive. McCormick is a Dividend Aristocrat, and that's not just some fancy name. It's an exclusive club of companies in the S&P 500 that have managed to increase their dividend for at least 25 consecutive years. As you can see, McCormick has blown right past that milestone. For any long-term investor who's focused on income and stability, this is a testament to a durable, cash-generating business that has weathered decades of economic storms. Let's just break down how insane this track record is. They are in their 102nd year of paying a dividend without stopping. Think about that longevity. But even more important, this is their 40th consecutive year of increasing that dividend. Through recessions, through market crashes, through global pandemics and crises, they have consistently generated enough real cash to reward their shareholders with a bigger and bigger check every single year. This demonstrates a core structural strength that you just can't argue with. It's a foundation that has been forged in steel over a very, very long time.
But, and this is a huge but, here's where this whole analysis takes a massive, sharp turn. All that digging we did into the sales, the profits, even that incredible dividend history, turns out that was all just the opening act. The biggest piece of news, the one development that completely rewrites the entire blueprint for McCormick's future, wasn't even mentioned in their earnings press release. This is the Unilever bombshell.
That's right. If you were just a casual investor, if you just scanned the financial highlights, you completely missed the real story. Management buried the lead deep inside the investor conference call that happened after the press release went out. This is a classic example of why you have to do the work. You have to listen to what management is actually saying, not just what they put in the glossy report. And here it is. This quote is the bombshell. Instead of starting with a normal discussion about the quarter, the VP of Investor Relations kicks off the call by announcing a massive combination with Unilever Foods. Now look, this isn't another mid-sized acquisition like the one in Mexico. This is a transformative, company-defining merger with a global consumer goods titan. This changes everything. So what's the logic here? What are they thinking? Let's walk through the strategic pillars of this deal. The goal is to create an undisputed global flavor powerhouse. Think about it. McCormick is strong in the spice aisle at the grocery store and on the restaurant table. That's what they call front of house.
Unilever Foods, with massive brands like Knorr and Hellmann's, is a giant in the sauces, the bouillons, the ingredients used in the kitchen. That's back of house. You combine them, you own the entire flavor experience. This deal also gives McCormick a massive pipeline into high-growth emerging markets where Unilever is already a king. And of course, the magic words, significant cost savings. This is a bet the company kind of move.
And all of this brings us right here to the final judgment. We've seen a core business with flat organic growth that's being hidden by an acquisition. We've seen accounting wizardry pumping up the bottom line. And now we've seen a colossal merger that is going to redefine the entire company. So the question is this the brilliant construction of a new global flavor empire? Or is it a dangerous trap for unwary investors?
Okay, let's put the bull case and the bear case right up against each other. The bull case, the argument for building an empire, is pretty clear. This merger creates a new global flavor powerhouse with scale that no one can compete with. They will dominate the category. The cost savings they can get are huge and will drive margins much higher. Plus, this deal instantly unlocks massive growth in emerging markets. A rock-solid Dividend Aristocrat is about to get even stronger. But then there's the bear case, the trap, and it's just as compelling. This looks like a hugely expensive merger that's really just designed to hide the fact that they can't grow on their own. The risk of trying to combine two massive, complex global companies is enormous. Deals like this fail all the time and destroy value. And meanwhile, the core business is still stagnant, and now the company's balance sheet is going to be strained under the crushing debt from not one, but two major deals. So the final, crucial question we leave you with is this. Is this combination the final, brilliant move that forges a new industry titan, an unshakable empire of flavor that will last for decades? Or is this a massive, desperate gamble? A merger built on the shaky foundation of a business that has forgotten how to grow on its own? That is the billion-dollar question that you, the investor, have to answer before you put your hard-earned capital to work. Thank you for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.